Hey everybody, welcome to Principles of Accounting. January here, it's snowing outside. Doesn't mean it's not a good time to talk about and think about baseball. And it's always a good time to think about accounting. So let's put the two together and see what we come up with. I've got in my hand the 2014 Cincinnati Red ticket book. And I've made my purchase for opening night. I can't afford opening day. I'm not a VIP. I can't get an opening day. I got to wait until opening night. So I made my buy 3 tickets for opening night, which is Wednesday, April 2nd, and I went ahead and paid with my credit card. Now, the Cincinnati Reds have collected money from me, but they're not going to be able to deliver that game until April 2nd, according to the calendar. So what the Reds have and what people have when they take a customer's money, but they haven't provided a good or service yet, is what we would call unearned revenue, or it's also known as deferred revenue. So what unearned revenue is a liability. And it's going to happen when a company takes money and they have yet to provide any kind of good or service. So, no good or service provided yet, but money has been collected. All right, so we had the Cincinnati Reds as an example and the opening night tickets that were bought in January and won't be able to be used until April. So we're going to take it from the standpoint of the baseball team, and we're going to say, let's assume that I paid $120 for the tickets. That cash they've collected already, so they're going to record cash of $120. Now, as we said, unearned revenue or deferred revenue is going to be a liability, so it's going to increase on the credit side. So the other part of that journal entry would be our unearned revenue. $120 credit. Now what would happen, let's assume we fast forward to April 2nd and the Reds actually play that game. They kind of reverse that out once they've earned that revenue. So we would have a debit to unearned revenue in the amount of $120. A lot of people get confused on the credit side. They don't really know what they're going to book the credit to. You see some people put cash in there. You see just kind of a lot of weird things that people try to put in there. What we're going to do is we're going to put into that credit revenue of $120. We've earned that revenue now on April 2nd by playing that game, so now we can count it as revenue. Two things have to be present for us to count revenue. We have to have collected money or promise that we're going to collect money, and we have to deliver the good or the service. So at that point in time on April 2nd, we played that game, we've delivered the good or service, and we can go ahead and count that revenue and get rid of the liability. So that's a quick and dirty way to account for unearned revenue. Now that's all for now. Hopefully you got a little bit out of that. If you have any questions, as always, feel free to get a hold of me. My email's right there. My Twitter handle's right there. I'd be happy to talk accounting with you. If you happen to have tickets for opening day, I'd be happy to take those off your hands too. Until next time, take care.